Hey everyone, it's Tim and Dustin here. Friday, November 21st at 9:45. We've seen a week of very high volatility across all asset classes. Same three themes: earnings, valuations, and the Fed. The market's rallying a little bit today on higher percentage that the Fed does ease in the beginning of December, and so we'll take it today and heading into the weekend.
Yeah, absolutely. As Tim mentioned, same three themes that we've been tracking here during this period of volatility. Um, uh, we kind of got a little bit of relief this morning when we had the president of the New York Fed come out and give a little bit of an indication that um, there might be a little higher odds of a rate cut in December, and the market liked that a lot. So hopefully we get back to um, focusing on the fundamentals and the earnings that Tim mentioned. But the Fed is one thing we're tracking. We've mentioned it before. They released their minutes on Wednesday, and although most of the attention was really focused on the December rate cut, and we've talked about that a lot. Um, what really is important to us here at Highway One is the discussion around the Fed's balance sheet. I know we've talked about it on previous calls, but currently the Fed's balance sheet has been overweight long duration bonds, with about 38% of the portfolio being 10 years and longer, versus a broader market of about 18%. But going forward, the Fed indicated in their minutes that were released on Wednesday that they plan to allocate more to shorter maturities. And why is this important? Why are Tim and I so focused on this? Is the Fed's overweight to longer duration really has arguably kept longer term yields lower than they would have been without all of that Fed support. So going forward, if they follow through with shortening the duration of their portfolio, and that's a big if, but if they do, it means that fewer dollars are going to go to longer duration treasuries. And that's another reason why we see the 10-year and out really remaining volatile and maybe even higher than others are forecasting. So we just, everyone talks about the easy monies at the long end of the curve, and we're not so certain about that. So we still have the 10-year between 4 and 4.5 through the end of the year. That's been our base case. We're what, Tim, 408, 409, 408 today,
408.
Which is kind of in the range where we've been. So we're keeping our eye on that very closely. And then as it relates to rate cuts, as Tim mentioned, our view hasn't changed since last week, as the odds of the December cut have gone down, even with the Fed, the New York president coming out today, being a little bit more, maybe friendly, but the stock market like that. But they're still pricing in no cut December or a 50-50. So we'll keep our eye on it. We'll update you next week, and everyone have a wonderful weekend. Thanks so much.